All right, so let's jump into this account. I wanted to look at a couple of things. We have a hedge on that we sold an in the money or at the money ES. This is a micro ES futures options. There's the only options that have the only micros that have options on them to this point. The other ones are probably coming in the near future. So I was trying to wait, and before we get on this meeting, before I adjusted this one, it's in the money now. Expect that we might be up today a little bit or stay around this price, around this level. So it was up about $15. It's now, you know, down since I put this on $10, which is insignificant. I received $75. I could wait until this. I will win regardless if this stays below 37.35, but it all expires today and it expires at 12 o'clock. So keeping that type of risk on is not appropriate. It's not a lot of risk. Obviously, it's not going to lose a lot on this micro, but I don't want to lose anything. So we're going to buy this back, and then we're going to roll this out. You can see we already got an order in already. So the market, for some reason, it's just got a bid in it. That always happens to me when I'm trying to hold off before I move something just for demonstration purposes. What
does that mean? What does that mean? The market has a bid when you say that?
I mean that people are buying it now. People are if you when you sell something, you sell on the bid, and that means people are buying on that bid. So people are buying the contract at this point and bringing it up. It's just,
that's good for you, right?
Well, that's good. That's not good for this position right here. This position is based on what it's doing right now.
Oh, because it's called short call, right?
Correct. This is a short call. So the premium just came out of it a little bit. So it's still up a little bit, but I don't really. This was a hedge, so I don't really care if this is going up or down. That's interesting. Something is off right now. Yeah, so it lost a lot of premium in this short period of time, and I had it at 9, and it's not filling. So, but anyway, if I would have done this earlier and not waited, I would have got out of this with a small profit and readjusted it to the next month. But now I'm going to get out of it and roll it out to keep this small short delta in this position. They're going to rob me right now because I don't think the market is going to be up more than what I'm going to make on this based on the premium. Once again, I received $75 on this. To lose on this is $5 a point. This is going to have to be, it's going to have to be up around 37.35. I don't think it's going to be that high, but since it's a half day, I'm going to adjust it anyway. And since it's a hedge, I want to keep the hedge. I'm going to move it out to a different month. I can't do it, or different expiration. I can't do it in concert on options on futures on the TastyWorks platform. You can on Thinkorswim. Hopefully we'll be able to do this first quarter of next year on TastyWorks. That's what they said. So we'll see if they're able to complete the coding of it and so forth. All right, so that just got filled, and you can see that for today we were up on it, but not up on the position. If we go and try to look at history really quickly, we'll see that we type that in. Let's just type in the MES, so you can see this. That is today. Let's look at it for about, I think I had it maybe 7 days. Let's look at it 7 days. So you can see it's been a small loss on this on the hedge, but that is perfectly fine. You want to lose on your hedge. So that cost us 9 to buy back. So what we're going to do is reposition and go to the next month. Let's clear that and go to the next expiration. Let's look at the 8 days or the 5 day or 15 days. Let's look at 15 days and see a new type of hedge. That was a 30-point wide spread. looking at that now, going back over here, and let's just say if we sell this 30 strike and buy 10, buy this here, this is 30 points, that's going to be 850, and that is a little less than what we had 2 contracts, so we just bought it back for 9. So if we move this up a little bit and get aggressive again, so that's the 975. So if we can get filled at this, we'll actually roll this for a credit if we can get the 975. So let me just make sure after fees and commissions that is the case before I send that order. We're going to just look at today again, and so it's about $92, as you can see here. I'm looking at this $92 that we bought it back for today. So if we go back over here, that's only $89 after fees and commissions. So we're going to go a little higher. We're going to go to the 35 delta, keep it 30 points wide, and now that's 96. So that would be a credit for this adjustment, and we can still keep some short delta with that. So we're going to let that play out for a second while we look at a couple other things. We have this riot that is up again today. It's up a little bit, about 62 cents, and you can see that that has still been a good trade. We've been trying to get people in and out of that. This Paychex one it was an earnings play that should have got out earlier, did not. It's at a 32 delta now, not adjusting that, not doing anything with that at this point. It's only 15 days to go. We'll see how that plays out. And we have this Airbnb one that's been going down for us as well. We made an adjustment yesterday from the 40 strike to the 35 strike. We moved down 5 points, and we paid for that by selling the call side, and we sold the call side around the 23 delta. It's a 20 delta now. So that position is fine, and it's 15 days to go to expiration. We're going to stay bullish on this, but just because I'm bullish doesn't mean I won't adjust it. So that's why we did that, betting that we'll still be able to win on this position within the next 15 days, hopefully within the next 10 at the most. All right, so then we got this RTY position. You can see that we have a put spread here that we rolled up, and we added a call side. We had the call side initially. We added one more contract to that. That is doing well to this point because the Russell has been going down 2 out of the last 3 days. And all right, so that is that. This is this ES position that we put on. We put on one of these positions last night on the webinar on options on basics. All of these positions are doing well as we look at this 15 days to go to expiration on the call side. That's a 14 delta, which is our green area, upper green area. This is a hedge that we did on one of the positions, so we do not care about that one. And the closest to at the money short position is a 14 delta, which is also our upper green area. So this is nice. Looking at the 19 days to go to expiration, you see that we have a 29 here, but that's what we put on last night on the event webinar. We're okay with that. You can see that this is a 5-point wide spread. We're okay with losing completely on that side, but we did add 2 contracts to the put side. We did a skewed iron condor. We did that at the 15 delta, which is the upper end of the green area. So we have no upside risk on that trade. So we're okay with that. All right, so let's break down a couple of things. I was looking at a trade this morning that she's not on the call, but she recommended this company here. You can see that it's been going up quite a bit recently, and it's so I was looking to do a put spread in this company here, doing LMND. What I was looking at this morning, we'll see if this is correct or not. Looking at it with 22 days to go, trying to get a quick little profit out of this, selling the 96 and buying the 91. When I was looking at it this morning, I can get 110. It's about 105 right now. Then I was thinking of 2 ways you can adjust this. You can or hedge this. You can hedge this in by buying the 100 and selling the 99. So you kind of have a small hedge in that. But this morning that was still giving me $100. That's only giving me 70 now, but that's still way more than 2%. So it's jumping around quite a bit, as you can see there. Or you can hedge this in the different expiration period. So what I'm going to do is sell this first and see if we can get it to sell. I'm going to try 110. This is a pretty good 5-point wide spread. Getting 110 out of that is not bad at all. So we're going to see if that will work. So here we go. We're sending this, and if we get filled, we will hedge this in this front month, or we'll hedge it in this 15 days to expiration by buying probably the 100, because you can see some of these are 5-point wide. We want it to only be 1 point wide, so we might hedge it by buying something like this in it and taking some of that. So that'd be about 30% of what we just received if we get filled at the 110. Right. So next thing I was looking at is AstraZeneca. This is a UK company that has came out with a vaccine. The vaccine is pretty interesting because it does not need to be stored in really cold environment like the Pfizer one. And so they're going to be distributing that now if they haven't started already. And I was just thinking about playing a small little trade 15 days ago, and an iron butterfly trade. This is the type of trade you try to get out of at 25%. It's already dropped quite a bit since I started. When I looked at this like about a half an hour ago, I was looking at selling the 50 and buying the 52 and selling and buying the 58, the 48. So this is a iron butterfly. An iron butterfly is selling a straddled and buying the wings. You can see that I was looking at it for 145. It's going for 150 now, but it's already dropped some. If we do something like this, let's see how that looks. All right, so if we do that, that's getting 162. But your max loss is a little more, right? So let's look at this here, going back to this, and I'm doing this based on the expected move here, right? So the expected move here is $2 basically. So we're receiving 150. The expected move is $2. So the most you can lose is $50 if you can get filled at this 150. So I'm going to send this, see if we can get filled. If we get filled, you want to take this off around 25%. It's not a high probability trade, but it's over a 50% trade if you take off around the 25%. You can see that the TastyWorks platform is saying about 37 probability of profit. That pop, that's what that means. That could be a little off. If you look at this based on the premium you receive, your break even is there's the 26 delta there on the call side, and on the put side it is the 37 delta. So if you add that up, 37 plus 26, that's 63. So you subtract that 63 from 100, and so TastyWorks is 100% exact right now. It's saying it's a 37% if you wait the expiration, but if you don't, I believe it's higher than the 50% chance. So I like the risk reward. I'm going to put this back at 50, and if we get filled, then great. If not, then then that's no problem as well. All right, so the next type of trade I have this morning for everyone is a SPX trade. This is one that I would recommend to someone that's new, that's trying to just make that 2 to 5% a month without a lot of risk and not a lot of flair. This is an SPX trade with 20 days to go that I'm looking at. And so if we go here and we look at selling the 35.10, so selling the 35.10, which is now a 14 delta, buying the 3500. This is a 10-point wide spread. I was looking at it for 90. It's only going for 80 right now. Some premiums come out of the market. So let's see if we move this up a little bit and do something like that. So if you do this one, this is a 90. I would then go into the SPY and hedge the SPY by doing a a different type. Let's say you get this at 90. I'm not going to do this trade in this account right now, but if you did this at 90, you'll get it $90. Basically, I just say just under 10% based on buying power. Then if you want to hedge this, which I recommend in this market right now, you go to the SPY in this case, and then you do a little different type of hedge. You go to the SPY, you go to 20 days to expiration, and if I can get this to work without messing this up. All right, so 20 days expiration, and instead of buying a put spread, this time you sell a call spread. It's the same kind of concept, but I'm just going to the 30 delta here, let's just say around this area, and I'm selling the call and buying the call. So selling the in the money 363, buying the 364. So the max loss on this is $20. You just received $90 on the spread. Okay, so this is why you're doing that. Even if you have full loss on this hedge, it's only going to be around $20 before fees and commissions. So I like this hedge, and you have a 30% chance of it actually expiring below there. So if it does, you win on both your hedge and your position. So this is a way to hedge it a little differently. Normally we're doing something like this. Okay? We're doing something like that. So if you can get filled, you can buy the hedge as well. I'm just showing you a different way to hedge, giving you a few different options. All right, so the last type of trade that I have this morning, trade idea, is selling the NQ and selling a put spread in the NQ with 36, not a put spread, a call spread. And so I really like this trade, and it would go against my nature to recommend selling the call side when I think the market is overvalued. Not that it's going to go down. I just think that if it continues to go up, it's going to go up at a slower pace. Could be wrong, have been wrong on that, but that doesn't matter. You can still make money when you're wrong, and that's the beauty of options. All right, so selling, in this case, selling the 13,670, buying the 13,710. So a 40-point wide spread. I was looking at it this morning at 575. If you do it at this, it's still you're still receiving at least $100, $103 if you do it. I like this trade. I'm actually going to send it, but let me just make sure I can see if I can get the 575 first, and I'm going to send that. And I'm glad I did that, because if I would have went to the 550, I would have got robbed. But I went to the 575, so just did that. And then what I could do if I want to hedge that a little bit, right? I just received $108 on that, right? So let's just say I've received $100. I can use up to $30 to hedge it, right? So what I'm going to do, that's 36 days the expiration. I'm going to do something a little different. I'm going to hedge this indirectly by going into the micro futures of the ES, right? The micro futures options. All right, so we said 50 days, we said that was 36 days. We're going to go here with this 36 days to expiration, and we're going to hedge the call side this time, right? So what I'm going to do is look to, that was around the 15 delta that we sold on the NQ. I'm going to look to around the 30 delta of this, and we're going to play with it a little bit. So buying, using about $30 to do this. So that is $26. And if I go here, that is $34, and it's going to hedge me up to $66 if I do that. Let's see what happens if I move this a little closer. That's $35. It's not gonna, that's gonna make it worse. So let's go back down here, trying to get a little bit more of a hedge. And that's a little better, of $30. If I go like this, that's going to cost me, it's going to cost me 36, and I'm getting $89 of a hedge if I can get filled. Go back there. So we're just going to go with this, just to offset it a little bit, and we're going to buy that. It's going to cost us $34. So 34 divided by 108. Divided by 108 is what we received on that percent. It's about a 31% hedge, and that's fine. I'm not going to force it if I get filled or not. So there we go on that. And all right, so let's open it up for any questions. Any questions on what we have executed to this point? All right, so just want to go back over to that micro ES position that we were trying to get filled earlier. Let's see, this is the that credit one that we were trying to get filled at. It's working. This one right here is the one that we were selling. Let's hit replace. This is the one we were replacing the one we took off earlier. Is that the one? Yeah, that's the one. So what we're going to do, that's the sale, that's the credit. We're going to cancel this, and then we're going to go back in and get it filled at the price that we want. All right, so that's working at 1050. That should get filled soon, but I'm going to adjust it a little bit. So that was the 3775. Let me just make sure I'm looking at that right. That's the 3840. What is that? That's the call side. And why is that 3775, 15 days to go? I'm looking at the wrong thing. All right, so let's go to and did I sell that? I didn't mean to sell that. I wanted to buy that. All right, so that's fine. All right, so that's the one we just bought. That's that hedge that we just bought on the ES. That's just got filled to represent that NQ position that we just did, this one here. And then we were selling the ES here with 15 days to go. We're going to do that again. We were doing it at the 3775. We're going to probably move that up. So we're going to go over here to the 15 days to go. Let's clear this for a second. 15 days to go with this MES. And what we're going to do is sell, instead of the 3775, we're going to go to this 3770. We're going to sell that, and we're going to do 30 points wide, and that's going to be there. That's going to give us 11. We're going to do 2 contracts of that, and then we're going to send it. That's going to give us $100 if we get filled. And we probably won't get filled, so I'm going to take it down to the 75, the 1075. We'll get filled right away. All right, so we're going to get about $99 off that. It was $90 that we bought that original one back for, $92. So now we just adjusted this hedge for a credit. All right, so and it's at the 36 delta. I'm perfectly fine with that. If it shoots all the way through, I'm going to wait all the way almost to expiration before I adjust this again, because it would have to get all the way up to this 26. That's going to be a pretty big move in the next 15 days. All right, so yes.
Now sometimes you're buying a put spread at the 30 delta to do your hedge, and sometimes you're selling a call spread on the opposite side as your hedge. So can you just maybe talk about why, in which case you're doing this as opposed to buying the put spread as your hedge?
All right, so yeah, so just to change up the position a little bit, the hedge a little bit. It's the same type of hedge though. It's the same thing. So for example, let me go over here and I just say we were looking at this 29 days to expiration, and let's say that we wanted to buy this 30 delta hedge on this SPY 1 point Y. You can see that this is, I just lock it in at 20. It's going to cost us $20 before fees and commissions. The max you can make on it is $80 if it goes and expires below this 360. And so that, but it's only a 30% chance that's going to be the case, right?
Yep.
So, and it's only a 30% chance it's even going to touch this 361. But you can go to the other side. You can do this to the other side. Let me just drag this like this, and then sell at that 30 like that. And then I just lock this in, and you can see that, excuse me, I'll lock this in at 80. You can see it's just the opposite. Your max you can make is 80, just like it was on the buy of the put side. Your max you can lose is $20 before fees and commission, just like it was on the put side. It's just semantics, a little something different, right? Instead of buying, you're selling. in
Yeah,
this
but
case.
you're selling it you're selling it at the 30 delta, not at the 70 delta.
Correct. So this is the 70 delta on the call side, but I'm basing it on the 30 delta on the put side. And the only reason I'm basing it on the 30 delta at the put side, because it's for me, it's clear to understand what are the probabilities of what's going to happen if I need for this position right here to win. It needs to go down, and going down is in this direction. So the
Yeah.
probabilities of it going down and being below that 161 for this to be a max win at expiration, it's only a 30% chance. Okay.
Right.
So, and it's just the inverse to this, right? So 70 minus 100 is 30. So you can get the same information from each side, but I'm just pointing it out based on the put side there.
No, but if you were going to sell that call spread, you wouldn't sell it at the 70. I just want to clarify. You would sell it at the 30 delta, sell the call side, the call spread, and it wouldn't be 1 point wide. It would be.
Well, I am selling this one here. This is a hedge. I would sell it at this 70.
Oh, you would. Oh,
Yeah, I would sell it at this 70. That's in the money. It's the same thing. It's just one is
okay. I
you're
haven't seen you do
buying
this
it and the
before.
one you're selling it. So I would sell it just like this. Just a different type of hedge. Like sometime I'll show you a hedge of buying a broken wing butterfly or buying a put spread. This is selling a call spread in the money to give you your hedge. So it's just a different type of version of the hedge that's going to hedge you the same way. So that's why I said it's semantics,
Okay.
how you want to do it. Okay.
Gotcha. But I haven't seen the 70 delta even in the course, and the one you were just setting up was at the 30 delta.
Correct. Correct. You've seen this in the course. You've seen
Yeah.
buying that, but
Yeah.
you haven't seen doing what we just
Correct.
said. And it's just so many different ways to hedge. So I couldn't that lesson 8 is already a lot already, right?
Yeah.
So it was just too much to throw in everything. But there you go.
Okay. Thanks.
But great question though. All right, so let's see what's going on here. See if it's anything else that we can get filled before we get off the call. So this AstraZeneca, we're still trying to get this filled. We're gonna let that sit at that 150. And then this lemonade company, it's that is 93. I would see if it fall a little bit. Let's go back over here. Once again, this was recommended by MM. She has had some good recommendations, just like Duvel. So it's made some money through her recommendations. I don't know much about this company. It's basically just a trade, a quantitative type of trade. And the risk reward to me is pretty attractive at this point with just 15 days to go. So this is why we were doing, or actually we were looking at 22 days here. So outside of the expected move, 5-point wide, I was trying to get 110. It is trading at, right now it's trading at, what is that? It's trading at 90. So we're probably, it's going to have to fall a little bit more for us to get that 110. So we'll see what happens in the later of the day. The Russell's telling us it's potentially we could have a fall later in the day, but we only have a few more hours left in trading. The market closes once again today at 12 p.m. Central Standard Time. All right, so with that said, it looks like a decent green day across the P&L day, which is always fun. All right. So, any other questions before we conclude with this live trading session? All right. So, if we don't have any questions,
Hey, O'Brien, I put a question in the chat.
Okay. Okay. Sorry about that, Gregory. I missed it. Do we always let the hedge expire worthless? Is that the point? No. The point is, great question, Gregory. It's what you're going to do with the hedge when you take off your position, then you immediately take off your hedge. So let's just say you receive 70%, 75% on your position you're trying to win on, or even 50. It all depends on what percentage you're trying to get on the trade. And once you take off the position you're trying to win on, you take off your hedge. So most of the time, not 100% of the time, but at least one standard deviation of the time, 68% of the time, you should be able to sell that hedge back to the market for it's worth something still. Okay, it's worth something still, especially if you're taking stuff off at like 50%, that hedge is still going to be worth, 30% of what you paid for it. So you can sell it back to the market. So for example, let's say I bought a hedge today for $30. Well, and then let's say I went on the position that I sold on. Well, I'm normally going to be able to sell that hedge back to the market around $10 or $8, something like that. So I'm not really truly paying that full $30 for that hedge because I'm not having that go to expiration. So, and that's the same thing with everything. Like you just saw me with that MES, I had a credit hedge. I sold a credit spread, a call spread, but I did not lose a lot on it, a very small amount. And then I moved it, I adjusted it and kept it to another expiration. So I'm okay with losing on my hedges, but I'm not okay losing all on the hedge, right? Because there's no reason I should lose all on the hedge. The only reason I should lose everything on the hedge is because I held my position too long, meaning that I tried to get 90%, I tried to get 95%, I tried to get a percentage that was too high, and then premium was coming out of those options too much. So the hedge is worth nothing. Even though you still won on that case, that's fine. But I try to get out of things usually on average around 50 to 75%, 75% for indexes, 50% for everything else, 50% after fees and commissions, right? You want to get that 50% after fees and commissions. But that's just a guideline. Once again, everyone, you've seen me get out of stuff at 30%. You see me get it out of 20%. You see me get out of the stuff at 90%. It's just a guideline. It's all how things are playing out with that position. And you'll learn that, you'll get that feel over time. But we teach people to give them a guideline initially until they learn how to, the feel of what they're trading. All right, so any other questions this morning?
O'Brien, this is David.
Yes. Hey, David.
In that AZN trade, it looks like it's going for a little more than $1.50 now, and my buying power for that is only $50. Is that something you would recommend for me?
Yes, sir. Yes, sir. This is that iron butterfly, correct? So
yes.
Yeah, this is the iron butterfly. So it's only $50 because the max loss is $50. So, okay. But you will not stay in this position for max profit. You want to get out of this position around 25%. All right, so because it's only a 37% chance of winning, but if you get out around 25%, you have, I believe, over a 50% chance. I can't quantify that. It's just that over time, I've learned that if you're getting out of stuff at before expiration, your probability is higher. It's like when I'm telling people, if you buy something at the money, for example, if you go like this, and you let's just say. Let's just clear this really quickly, and let's go to this. Let's go to this, and let's say you're bullish on this, and you want to buy a call spread. We don't do that very often, but let's just say you want to buy this call spread. Well, this is a 50-50 shot at expiration to win, right? So that's basically. But if we want to get really technical about it, you take how much you have paid, right? The 258. Right? I just round this down to 250 for just easy math here. So you would have to go up to, it has to go above 374.50 before you can win. Okay, it has to be in this area before you even break even, right? Because you're paying $2.50 or $250 for this spread, right? So if it's going to be above that, what is that telling you here? What's the probabilities of it being above, expiring above that 374? It's a 41% chance of that happening, right? So that's less than 50, but just for easy metrics, as TastyWorks is talking about here, it's saying probability of 43%, right? But for simplicity purposes, we tell people if you're buying at the money or selling at the money, you got a 50% chance of winning. But that's at best, right? That's at best. But if you that's at expiration, but if you get out of this before, that means your probabilities are higher than this, because what's the probability of touch here? Okay, what's the probability of touching here? That's the probability of touch is 2 times delta, right? So that's 34 times 2. That's a 68% chance that it's going to touch this 377, right? So I guess I do have the math to quantify that feeling that that's saying that it's more, you have a higher probability of winning if you get out of something before expiration. So if you take that 25%, you got a higher than 50% chance of winning on that. So so in this case, if let's just say it does touch 377, well, you're not going to have max profit at that point. You're not going to have $250 max profit, because that's not going to be the case, because there's still time involved in it, right? But you're going to have a profit. It's going to be worth more than this 250 at that point. It's going to be worth more than that 250. So if you ring the register, you have won on that trade. You have beat the odds of just 43% at expiration.